Welcome to the deep dive. Today, we're going to be talking about Forex and specifically the trading environment.
Okay.
You wouldn't set sail without a chart.
Right.
So why jump into Forex without understanding the market conditions?
That's a recipe for disaster.
It is, which is why we're diving deep into Know Your Trading Environment
Okay.
from BabyPips.com.
Yeah, I've heard of that website.
They're known for making Forex trading accessible.
For sure.
And we'll be pulling out the most valuable intel from this piece.
Sounds good.
Okay, so imagine this.
Uh-huh.
A basketball coach
Okay.
sends their team out to play without knowing who their opponent is.
Oh, wow.
Talk about a mismatch.
Yeah, that's not good.
And trading without understanding the market environment is equally clueless.
You need to know what you're up against.
So many traders get hung up on finding that one perfect system
Oh, yeah.
and then get frustrated when it doesn't work.
Right?
They blame the system when the real problem is.
They're using the wrong tool for the job.
Exactly. So instead of searching for a magic bullet, we need to become chameleons,
Okay.
adapting to the ever-changing market.
So adapt.
Adapt.
I like it.
Baby Pips outlines 3 basic environments:
Okay, let's hear them.
trending up,
Okay.
trending
You
down,
had it.
and ranging.
Right, ranging. Okay.
So what does that look like in practice?
Okay, so imagine you're looking at a price chart.
All right, I'm looking.
A trending market is like a staircase.
Up or down?
Either. It could be going up or down.
Okay.
An uptrend shows higher highs and higher lows.
So each step is higher than the last.
Yes, exactly. Both the high point and the low point of each step.
Got it.
Now, a downtrend forms a pattern of lower highs and lower lows.
So it's the same concept, but in reverse.
Exactly. You're seeing lower highs and lower lows.
Like walking down a staircase.
Yes, you got it.
Okay, so in a trending market,
Uh-huh.
whether it's up or down,
Yeah,
the key is consistency in those peaks and valleys.
you got it.
Now, what about ranging markets?
Okay, so for ranging markets, imagine a ping pong ball bouncing between 2 paddles.
Okay, I can see it.
The price moves sideways between a support level and a resistance level.
So the price is the ball.
Yes,
It's stuck in a channel bouncing back and forth.
exactly. Think of support as a floor and resistance as a ceiling.
Okay, so the price might test these levels multiple times,
Right.
but it stays within that range.
Generally, yes.
So knowing this helps us make smarter decisions.
Absolutely.
Like if we identify an uptrend, we don't need to stress about catching the absolute lowest price.
Nope. You just got to ride the wave up.
Buy during those dips or pullbacks,
Exactly.
knowing that the momentum is upward.
That's the idea.
And if we spot a ranging market,
Then you play ping pong.
I like it.
You buy near the support level when the price is low,
Okay.
and then you sell when the price bounces back up near the resistance level.
So choosing the right strategy is just the first step.
Right.
You also need the right tools.
That's where indicators
Yeah.
come in.
Ah, yes, indicators. I've heard of these.
Like Fibonacci retracements,
Yeah.
trend lines, pivot points.
I'm a bit fuzzy on what those actually mean.
Think of them as your market reading glasses.
Okay,
They help you to see the patterns more clearly.
got it.
For instance, in a trending market, trend lines help you to visualize that staircase pattern.
So if I'm looking at a chart
Yeah.
and I spot a clear uptrend,
Okay.
I can draw a line connecting those higher lows.
Yes,
And as long as the price stays above that line, the uptrend is likely to continue.
exactly. That's the basic idea.
I'm starting to see the light here.
Good. Now, Fibonacci retracements, they help you anticipate those pullbacks or breaths
Okay.
that the market takes within a trend.
So even in an uptrend, the price doesn't just shoot straight up.
Right.
It takes pauses. And Fibonacci levels can help us predict where those pauses might occur.
That's the idea.
Wow, okay, so there's some logic behind these levels. They're not just a random guess.
Not at all.
What about pivot points?
Pivot points are your go-to for a ranging market.
Okay.
These are calculated levels based on the previous day's price action.
And they can help us to identify
Yeah.
potential areas where the price might bounce off of support or resistance,
That's right, like those dotted lines on a tennis court.
showing us the boundary.
Exactly.
Okay, this is just scratching the surface.
Yeah.
We're going to dive deeper into these indicators and their specific applications in part 2.
We will.
But the key takeaway here is
What is it?
knowing the market environment helps us choose the right tools for the job.
You got it. It's like having a toolbox
Yeah.
full of specialized equipment.
Okay,
You wouldn't use a hammer to screw in a bolt.
definitely not.
Same thing with trading. You need
Right.
the right tools.
Now, all of this is fascinating, but let's be honest.
Okay.
Markets aren't always textbook examples.
Right.
What about those times when it's not so clear-cut.
You're right, the market can be a bit of a trickster.
A trickster. I like that.
That's where things get even more interesting.
More interesting.
Because sometimes a market might show characteristics of both a trend and a range, or it might be transitioning from one to the other.
Oh, that's interesting.
Yeah.
So how do we unravel those more complex scenarios?
That's what we'll be diving into in part 2.
Okay.
Exploring how to identify those subtler market states and develop your own interpretations.
Ooh, I like that. Develop your own interpretations.
It's all about becoming a market detective.
Awesome.
But for now, those 3 basic environments are a fantastic foundation.
A fantastic foundation
to build on.
So stay tuned. We got a lot more to unpack in part 2.
I can't wait. Welcome back, everyone. In part 1, we talked about why understanding market environments is crucial for Forex trading. Now let's roll up our sleeves and delve deeper into those 3 main environments. BabyPips outlines.
Okay.
Trending up, trending down, and range.
All right, so imagine I'm looking at a price chart trying to decipher what the market's doing. What should I be looking for to figure out which environment we're in?
Great question. Let's start with trending markets. Picture a staircase. If each step is higher than the last, that's an uptrend. Prices are making higher highs and higher lows.
So it's not just about the price going up overall, but the pattern of those peaks and valleys.
Exactly. That's how you distinguish a true trend from a temporary blip. Now, a downtrend is the same concept, but in reverse. Like walking down a staircase, you're seeing lower highs and lower lows?
Okay. I think I'm starting to get the visual. So in a trending market, whether it's up or down, the key is consistency in the direction of those peaks and valleys.
Precisely. Now let's shift gears to ranging markets. Imagine a ping pong ball bouncing between 2 paddles. The price is the ball moving sideways between a support level and a resistance level.
So instead of that staircase pattern, we're looking for a price that's kind of stuck in a channel, bouncing back and forth between those boundaries.
Exactly. Think of support as a floor and resistance as a ceiling. The price might test these levels multiple times, but generally stays within that range.
Okay, that makes sense. Now let's talk strategy. If we've identified an uptrend, what's the game plan?
Ride the wave. Look for opportunities to buy when the price dips or pulls back. Remember, even in an uptrend, the price doesn't move in a straight line. Those pullbacks are your chance to jump in.
So we don't need to try to time the absolute bottom.
Trying to catch the exact bottom is like trying to catch a falling knife. It's risky. It's much safer to wait for a pullback, confirm the uptrend is still intact, and then buy.
Okay, that feels less stressful already. Now, BabyPips mentioned Fibonacci retracements as a useful tool for trending markets. How can those help us?
Fibonacci retracements are like those markers on a hiking trail that tell you how far you've come. They help us anticipate potential levels where the price might pull back before resuming its upward journey.
So it's not just a random guess. There's some logic behind these levels.
Absolutely. Fibonacci retracements are based on a mathematical sequence that interestingly appears often in nature, and it turns out in financial markets as well. The key levels to watch are 23.6%, 38.2%, and 61.8%. These are often points where the price pauses or reverses.
Wow, so there's a whole mathematical theory behind this.
Yeah.
Fascinating. So if I see the price pulling back to, say, the 38.2% Fibonacci level in an uptrend, that might be a good opportunity to buy, anticipating that the upward momentum will resume.
You're catching on quickly. Now, another useful tool for trending markets is trend lines.
Right, those lines you draw on the chart. But how exactly do we draw them correctly?
In an uptrend, you connect the lows, those valleys in the staircase. This line acts as a support level. As long as the price stays above it, the uptrend is considered intact. If the price breaks below the trend line, it could signal a potential shift in momentum.
So it's like a warning sign, like, hey, the bulls might be losing steam.
Precisely. Now, in a downtrend, you do the opposite. You connect the highs, the peaks of the staircase to form a resistance line. A break above that line could signal the bears are losing control.
Okay, so trend lines help us visualize the overall direction of the market and also alert us to potential changes in momentum.
Exactly. Now let's switch gears to ranging markets. Here, the name of the game is to buy low and sell high within that bounded channel.
Right, playing that ping pong between support and resistance. But how do we know where exactly to buy and sell?
Pivot points can be really helpful here. These are calculated levels based on the previous day's high, low, and closing price. They provide potential turning points within that range.
So if the price is near a pivot point close to the support level, that might be a good opportunity to buy, expecting it to bounce back up towards resistance.
You got it. And conversely, if the price is near a pivot point close to resistance, you might consider selling, anticipating it to drop back down towards support.
Okay, I'm starting to see how all these tools work together to help us make more informed trading decisions. But I have to admit, markets can be tricky. It's not always as clear-cut as a perfect staircase or ping-pong match. What about those times when it's not so obvious which environment we're in?
That's where things get really interesting, and that's what we'll be focusing on in part 3. We'll explore those more nuanced situations and discuss how to develop your own interpretation of market environments.
Intriguing. Can't wait to dive into that. So stay tuned, folks. There's more to come in part 3.
Welcome back to the final part of our deep dive into Forex trading environments.
We've talked about why understanding these environments is crucial.
Yeah.
And how to identify those classic trends and ranges.
Right.
But now, let's get real.
Okay.
Markets aren't always so picture perfect.
You're absolutely right. In reality, things can get messy. Sometimes a market might seem stuck between a trend and a range, or it might be transitioning from one to the other.
So how do we handle those trickier situations? How can we become more fluent in reading the market's language, even when it's not speaking in clear sentences?
It's all about developing your own interpretation, going beyond those textbook definitions.
Oh.
Remember, those 3 environments are just starting points.
So it's like learning the basic grammar rules, but then you start to understand the nuances and slang of a language.
Exactly. Start by really observing price action. Ask yourself, is the market showing a clear direction, or is it more like a tug of war between buyers and sellers? Are those highs and lows consistently moving in one direction, or are they bouncing around within a confined area?
So even if it's not a perfect staircase pattern, if we're seeing higher highs and higher lows forming over time, we could still be dealing with an uptrend, even if there's some sideways movement mixed in.
That's right. Don't get too hung up on those perfect textbook examples. Markets are fluid and dynamic.
Okay, that makes me feel a little less pressured to categorize everything perfectly. So, observation is key, but how do we use those indicators we talked about in those less clear-cut situations?
That's where things get even more interesting. You can start to combine different indicators to get a more holistic view. For example, let's say you're looking at a market that seems to be ranging, but you notice the price is consistently bouncing off a rising trend line.
So it's like the range itself is shifting upwards, almost like an escalator instead of a staircase.
That's a great way to put it. That could suggest an underlying bullish bias within that range. You might consider adjusting your trading strategy accordingly, perhaps looking for opportunities to buy near support and holding for a longer period, anticipating an eventual breakout to the upside.
Okay, so instead of just focusing on those quick ping-pong trades within the range, we're thinking about the bigger picture and potential shifts in momentum.
Exactly. And this is where your experience and judgment come into play. There's no magic formula. It's about becoming a market detective, piecing together the clues and forming your own hypothesis.
So it's a constant process of observation, analysis, and adaptation.
You got it. And remember, time frames matter too. A market might look like a range on a shorter time frame, but a trend on a longer one.
So a day trader might see a ranging market, while a swing trader sees an uptrend. That's mind-blowing.
The market is like a fractal each zoom level, revealing a different perspective. The key is to choose the time frame that aligns with your trading style and goals. And don't be afraid to experiment and refine your approach over time.
This has been such an eye-opening journey. We've gone from feeling lost at sea to having a compass and a map to navigate those Forex waters.
Remember, trading is a skill that takes time and practice to develop. Don't get discouraged if you don't become a master navigator overnight.
The most important takeaway is to be aware of those market environments, to use the right tools to analyze them, and to constantly adapt your strategy based on what the market is telling you.
And never stop learning. The markets are constantly evolving, so your education should too.
Thanks for joining us on this deep dive.
Yeah, thanks for listening, everyone.
We hope you've gained some valuable insights to help you on your Forex trading journey. Until next time, happy trading.